And welcome to today's Making Sense. Ever wonder who sets federal interest rates or how they're even determined? There's been a lot of talk about it in the news lately. Why does borrowing get cheaper when rates drop? What do lower rates mean for mortgages, savings, or maybe even those student loans? Well, we're breaking it all down tonight in Making Sense, sharing how rate changes may impact you. Justin, thanks so much for joining us. All right, so you're going to teach us all the stuff that we've been hearing in the news and that we kind of know or kind of think we know. You're going to actually let us know whether we do, right?
Yeah, we'll see if we can bring a little bit of clarity. We won't get too down and dirty with it, but just kind of making a little bit of sense of some of this stuff that we hear. Every few months lately, anyway.
Right, absolutely. And we're also going to talk a lot about how this impacts us at our level. We hear about it a lot at the federal level, but this can impact our bottom line. So let's start with the very basics. Who's responsible for setting the federal interest rates and how are they determined?
Sure. So we refer to them as the Fed, right? And what we're talking about is the Federal Reserve. That is the entity that's responsible for setting the interest rate, the key interest rate. Specifically within the Federal Reserve, there's a group called the Federal Open Market Committee. And they meet regularly, and that's around 8 times a year. What they do when they meet is they're looking at the economy. They look at a number of factors. The ones we hear about are inflation, employment, and basic economic growth. And they take these and other factors into account and make decisions to raise, lower, or keep rates the same. And what they're trying to do, or what they should be trying to do, is keep a stable economy. They're going to lower rates to encourage borrowing and spending during slowdowns, and then raise rates to try and cool inflation when prices are just getting out of hand. So that's who they are and basically what they're trying to accomplish when they're making changes to rates.
So they're kind of walking that tightrope, but they're supposed to be, I don't know, I guess in some watchdogs of a healthy economy, I guess, maybe.
That's right. And there's all sorts of analysts out there. And then all of us as consumers, many of us have our own opinions too on what should happen. So I'm not saying that everyone's going to agree with the approach they take or the decisions they make, but that's why they exist and the mission they're trying to carry out.
Got it. And maybe why there's a whole bunch of people involved in that decision and not just one person. Right. So what does it mean when the Fed lowers interest rates? What does that really mean?
Well, it doesn't mean that they have control over what your local banks and credit unions are doing with interest rates, right?
Okay.
What they're doing is they're working with a key interest rate, and that's the rate they're working with is the rate at which banks borrow money from each other. Okay. Because what do banks typically and lenders need to do is they need to have funds on hand to lend out to their customers. And so this is the rate at which money changes hands between banks. And then that goes on to and has an impact on all of the interest rates that we as consumers experience, whether we're borrowing, saving, or whatever. It's just the key rate that has an impact on many other areas of interest, whether it's for saving or borrowing.
Okay, so let's break that. So that's the rate that banks work with other banks with.
Yes.
Right?
Yeah.
Okay, I'm totally asking on this. So that sets that rate. But then that rate can impact mortgages, auto loans, credit cards. It gets passed on to us, right? That's the question.
Yes, it's going to influence. What it's going to do for us is it's going to influence the rates that we borrow at or that we earn interest in our savings. It's the rate that most typically people look at. But when you're talking about this Fed rate, where you're going to see the most quickest reaction when the Feds make a change to a rate is more in your short-term borrowing. So your consumer loans, auto loans, unsecured loans, that's where you're going to see pretty quick movement. It does have an impact, maybe indirectly, to mortgage rates. Mortgage rates are longer-term rates. they typically are priced based off from US Treasury rates. So, and they have that, those rates have a little different way of fluctuating or coming to be. So it's all a trend, right? So this one Fed rate is going to have an impact on the other rates, or other rates will be adjusted according to what the Fed rate does.
But it sounds like maybe most quickly and most directly with those shorter term kind of loans is where you're going to see the impact.
You're going to see that movement in the shorter term loans,
okay,
in the short time deposits, or our liquid deposits, whether that's your checking account, savings account, money markets, things like that. They're likely going to price and move a little bit quicker with these Fed rate changes than longer term items, such as a 30-year mortgage, for example.
But what that rate, that announcement of a rate, yes, it may have those short-term loans, but it has such far reach, because the reaction, you can watch Wall Street.
Yeah,
they're not taking out a car loan, but Wall Street reacts based on the nod or the thumbs up or thumbs down. It feels like that when it comes to those interest rates. So, all right. So if, you talk to any, especially first-time home buyers out there right now, and it is a tough time to buy a home. Anyway, anybody, but especially for the first-time buyers across northern Michigan, does a dropping rate make that any easier for them? Even though you've explained that it may trickle down, does that make it any easier for those folks?
It sure does. Anytime that it's cheaper to borrow today than it was yesterday, it's going to help you out, right? Especially when you're borrowing for a home, one of the primary underwriting factors is how well can you afford this payment? And a lower interest rate means a slightly lower payment. So you're either going to be able to afford more home, or you're going to be able to afford to get into a home when maybe when rates were higher, you weren't able to. So it definitely puts first-time home buyers in a better position.
And anytime you make it more appealing to move, it feels like that helps the home buyers out there, because the people that were in those starter homes, hey, rates are dropping a little bit. They can now advance to the second home, which frees up the starter homes for the first-time home buyer. So we can kind of get that moving. So the rates may help with that as well. All right. So how do lower rates impact like saving accounts and CDs, certificate of deposits?
Oh boy, this is the downside, right? Because we just came off from a recent decision from the Feds to reduce rates. So here's the downside. While loan rates went down, well, so do savings and deposit rates. So your liquid accounts, savings accounts, money markets, and CDs. Now, not CDs that you already have, because those are generally fixed. But a CD today is probably going to earn a little bit less than it did before the rate cut. So as good as it is to see rate cuts on the borrowing side, we're also going to earn less on our deposits. So.
And can you explain to me why that is? Like, why my savings account, Fed cuts rates,
mm-hmm.
I may make a little less interest on my savings account?
Yeah, they could go down that way. It really depends on your deposit institution, whether or not they decide to make a change in their deposit rates as a result of the Fed rate change. But on short-term money, that's often what we see happening.
Okay, I'm going to ambush you on this one, Justin.
Yeah.
So this isn't fair. I apologize.
Go for it.
But it feels like lately there's been a lot of buzz about these high interest savings accounts,
mm-hmm.
right? Like not the percent, like not tiny little numbers, but 4, 5, 6, pretty big numbers for percentage. If the Fed cuts interest rates, would we expect or anticipate to see also a lower interest rate that we would be earning back on high interest accounts?
It's really a business decision at each deposit institution.
Okay.
What I'm seeing on it, one of the popular things out there right now are high yield checking accounts. Okay.
Yes. Okay.
And what I've been seeing is a lot of those rates are staying strong there. And one of the reason is it's a great program. It's a great product that these banks and credit unions have. There's usually a hook in there, though, that you have to do something to earn that elevated interest rate.
Right.
You might have to be signed up for electronic statements. You might have to use your debit card so often and have direct deposit in these things. And many times, the deposit institutions, they'll keep those rates on those specialty accounts high because it's worth it to have your depositors have that relationship with you when they have their direct deposit and are using electronic statements and utilizing their debit cards. That is a valuable customer for a depositor to have. And so it comes down, all of these rates do come down to a business decision at a bank or credit union level, because they want to make sure they keep their customers and their members happy and keep them in their institution. So you're not always going to see a drop there as a result of a Fed rate change, but it's certainly a business decision that they could make. And oftentimes in a lot of those programs, you're limited to the total balance you can have in that account and earn that attractive higher rate.
Sure.
Sometimes there's a cap on it. So definitely a way, look for those opportunities though, because while other rates are going down, those might be staying strong.
All right, good to know. All right, so a Fed rate cut is good for first-time home buyers. How is it impact people that are still paying off student loans? Help or hurt?
Well, it doesn't hurt generally, because a lot of private student loans with variable rates, you're gonna see a benefit to a rate cut. You're probably going to see a lower interest rate. On the federal student loans, those are usually set. You're probably not going to see any changes there. So, you're not going to get hurt necessarily, but you're not going to see any improvements unless you have a private variable rate student loan.
Okay. So we saw Wall Street react to the recent news. How do businesses and the job markets typically benefit when rates are lower?
Well, there can be a lot of opinions on this, right?
Okay.
But just generally speaking, rates are lower. Businesses are going to it's going to be less expensive for them to borrow money, to expand, to bring on new product lines and do all of these things. So if they can borrow money at a lesser rate, theoretically, they're going to be able to increase their labor force or expand, and that could really help out the job market. Now, whether or not businesses in general really do that, we don't really know, right? But some will, some won't, and there's going to be some balance in there. But it at least creates the opportunity, as compared to if a business is paying higher borrowing rates, it's going to reduce their available capital to invest into expansion and new product lines and possibly increase their workforce. So generally speaking, I would say a lower interest rate environment as the rates go down is going to provide that opportunity for job growth and economic growth as a result.
So if they do borrow at that higher rate, it's going to cost them more. So more money's going into that. Or people may be holding off to even making that move until the rates come down. So they may not actually even take that step, and they may just be on pause, right?
That's right.
Okay. So you mentioned that one of the factors, and correct me if I'm wrong in this, but you mentioned one of the factors that goes into whether the Fed cuts rates are things like inflation. Mm-hmm. And we're all dealing with inflation every time we go to the grocery store or seem to buy anything, right? It costs more now. So that's one of the data points that they look at when they decide if they're going to cut rates. But how does a rate cut turn around and then impact inflation, or does it not?
Well, again, there's a lot of schools of thought on this topic, but the message that I would give here is that when rates are cut, the cost of borrowing goes down, and when the cost of borrowing goes down, people generally spend more. So if they're out spending more because their cost of borrowing is down, that could create demand for certain products and services. And when demand goes up, suppliers can charge more. So that could result, decreasing rates could result in increasing inflation. And then if rate cuts come at a time when inflation's already high, it could have an even more broadened impact. So the feds, they're tasked with balancing that. For every action there should be an equal and opposite reaction. This is one of those cases. Now, again, many arguments as to whether or not what really happens, but there's also a lot of data out there, and we can look at that data. But that's the risk that's taking place out there. For those folks and viewers that are in their borrowing years, we want lower interest rates, and so that we can get the goods and services that we want, but that we might be driving the demand and the price for those up. But yet, those folks that are outside of their borrowing years, more in their saving years, retirement years, they're looking for those higher rates on their deposits. So trying to balance everything for an economy is got to be a tough balancing act to make.
Yeah, let's talk a little bit more about what should individuals do, or what should individuals not do with their money when the rates drop?
Well, when the rates drop, it's a better time to borrow than when they're high, right? Even if you don't go out and borrow just for the sake of borrowing, but
it's a good deal, right? Yeah.
If you have a need, it's a good time. But maybe even more importantly, I know we only dropped 0.25% recently, but take a look at your finances. Take a look at your balance sheet. What loans do you have on the books? What rates are you paying? Is a refinance a smart move? Can you save a few bucks or even more if you were to refinance your mortgage, a car loan, or other debt at a lower interest rate? Of course, talk with your bank or credit union, get some advice on that. Sometimes, if borrowing involves, closing costs and stuff like that, you're going to want to figure that into it too, to make sure you understand how long it's going to take to recoup your savings and interest. So definitely give that some consideration. And then when rates are falling, take caution with your savings, especially if you're using a portion of the interest you earn to live off from or for future plans, because what you're earning may be going down. So you're going to have to factor that into what your future plans are and what your savings goals are to make sure that you're meeting your goals. And if you have a bunch of money, maybe in a savings or money market account, and you feel that rates are trending down, maybe it's a good time to take advantage of a certificate of deposit where you can lock into a rate for a period of time. Consult with your financial advisor. Go find a financial advisor if you don't have one, and just talk about the strategies that are available to you in a falling rate environment. And then the last thing I'll say, as rates have dropped a little bit here this year and may continue to drop, avoid overspending. Just because you can borrow it doesn't always mean you should. Have a plan. You've heard this before, Mark. I've said it so many times, right? Have a plan, have a budget. Work within that plan and budget. It can be really easy to have a lot of wants and find ways to finance them. But even though we can enjoy lower interest rates from a borrowing perspective, make sure that you don't put yourself in a position that's going to become uncomfortable with your household budget.
Oh, that is smart. It's rates go down, the money's not free. It's it's a little cheaper, but it's not free, right? And the Fed meets, you said, 8 times a year.
Yeah, just about. That's all. That can be subject to change, but they have a tentative schedule of that.
And they keep a close eye on what is happening, and clearly, based on how so many people all across the country and the world keep bated breath on the day that they know that they're going to make that announcement, it's hard to know what they're going to do. And so that's definitely, if you have questions on whether now's the time to move or what would a move do, go talk to your financial institution, let them run the numbers, right?
That's right. We're always glad to help.
All right, Justin. Hey, I appreciate the 101 on the Fed. We all are a little bit smarter for it, and hopefully can make better financial decisions because of it. Justin, thank you so much for your time tonight.
You too. Have a great night.